Hello, good afternoon. Today's edition of the Final Bar will include a market recap, a bit of distribution today. So we're going to unpack what that means for the long-term trends, look for some lines in the sand for the broad markets, for technology. Also think about bonds and other places where assets seem to be rotating. We're going to have a sector setup segment where we break down the 10 S&P sectors. We're going to open the mailbag, answer your questions. Ladies and gentlemen, this is the Final Bar. Hello everyone, welcome to today's edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Appreciate you joining us every weekday, 4 o'clock Eastern, 1 o'clock Pacific. The goal of this show is to break down the action of the markets for today from a technical perspective, but more importantly, connect it to the long-term trends. A lot of times we get caught up in the short-term, flickering ticks, the little movements, day-to-day, the little themes. Let's think about the big picture. Let's think about how it relates to the overall trend-following mechanisms, the momentum that we can follow, looking across assets, using the power of stock charts. Let's get right into the markets, because today, obviously, a bit of distribution. We had a sell-off yesterday and certainly follow through to the downside. And again, we don't dig too much on this show into the reasons why these patterns tend to emerge. So obviously a lot of rumors about or discussion about the U.S.-China trade agreements, a huge delay in that, and obviously people pretty skeptical of that happening anytime soon. But again, as a technical analyst, from the technical perspective, you don't care a lot about what the reasons are. The reasons as to why the chart looks a certain way usually are very clear in the rearview mirror. After trends have changed, after trends have evolved, the reasoning as to why things played out a certain way tends to be more clear. But at the time, it's all about looking at the charts. It's all about looking at the price and see how price moves relative to what you've heard. So this is what happened yesterday. We had that big sell-off. Friday's session held up okay. The big distribution yesterday, the follow-through to the downside. What's interesting today reminds me a lot about when I taught technical analysis at the college level. I taught it at Brandeis University outside of Boston for a couple years to second-year master's students, and it would be so funny. I would assign a major market review that the students would all have to present sort of their final project talking about the markets, and inadvertently in the week leading up to that presentation, the markets would completely change. It was usually around September, October. There would be dramatic movements, and their entire thesis would be blown. I feel that way a little bit getting ready for the Final Bar. We're sitting here in the studio, we're all ready to go. And as we're sitting here, the bars are slowly changing as the market's rallying in the 3 o'clock hour Eastern, sort of heading into the close. And that's certainly what happened. So on an intraday basis, here's the gap down we see from yesterday's session to today's. This is the spiders now. A little bit of sell-off in the first 15 minutes, and then really a slow and steady rally leading higher. So the initial reaction was sort of to the news, pre-market overnight. And then we had sort of a slow accumulation at last 30 minutes, certainly more positive than negative, more buying than selling on average. So what does that mean to the long-term trend? Again, the key with charting, in my opinion, is to look at where we're at and relate that to where we've been. Where are we at relative to key levels? And what we talked about yesterday and before yesterday was, an uptrend is a series of higher highs and higher lows. We have seen that. When the market sold off yesterday, it's all right, let's look to the most previous low, which on an intraday basis, and we had a question on this, intraday versus closing levels. We'll talk about that in the mailbag segment. But on an intraday basis, the low I'm circling here was a week and a half ago. It was the low around 30.90 on the S&P 500. We've traded below there intraday, certainly, but today's action certainly saw accumulation leading into the close. So this looked a bit like a hammer candle. I don't know if you can really call it that because we rallied so much going into the close, but certainly shows buying going into the close and more accumulation from the starting point of the day. So overall, we have found support. We have established this support range, which we talked about. 38.90 is this level here. Back here is around 30.75. That's the low from the beginning, the first week in November. We've now sort of established price around that level, and now the question is follow through. Going into tomorrow, do we continue? Do we have a confirmation in the form of some lower close, some sort of further distribution, or is this a buyable bounce as things start to rally? Based purely on today's price, it's hard to make a very clear judgment. you had, gun to my head, what would you say? You'd assume, probably more upside than downside in the short term just because of the accumulation leading into the close. But again, that's all about the confirmation we see from the next day. So that's sort of where we're at. I did want to point out one breadth indicator. I'm looking really quickly here to my breadth chart list. One of the things that I tweeted out earlier, I had a good discussion going with some of my friends, was on the McClellan Summation Index. A lot of you may be familiar with the McClellan Oscillator, and Tom McClellan writes a column on StockCharts.com in our top advisors corner, which is very, very good. The McClellan Oscillator is essentially an advanced decline read, but it's smoothed out with some exponential moving averages. And overall, if the McClellan Oscillator is above 0, overall the breadth is positive. If it's below 0, the breadth is negative. And you can see we briefly rallied above there last week, but now back below, and sort of illustrating more negativity, more distribution. But what's key here is the summation index, which takes that daily read and accumulates it over time. So it's sort of like a cumulative advanced decline for the McClellan Oscillator. And this is the line I'm showing here. And overall, I've found it's helpful to just look at breakouts and breakdowns and where it's breaking out of a certain level. And you can see we had the big rally out of the market lows at the beginning of this year, then sort of a distribution leading into the summer months, and then this sideways consolidation pattern, and it's really been in this range for quite a while. And I illustrate, this is a pretty crudely drawn trend line, so don't take that as a particular line, but just to illustrate the overall consolidation. This McClellan Summation Index has essentially been sideways. We've had this cyclical nature, even though the market's been stronger, overall the breadth read over time has remained relatively stagnant according to this. And if we would see a breakdown, if we see further downside, and I would think breaking below the previous low here from October, or breaking above these highs around 800 on the read, which would be above the highs from sort of late summer months, that would indicate really a follow-through of momentum, a follow-through of breadth really on one side or the other. We haven't seen that yet, but that's one of the charts that I would be looking at if you haven't been already. Let's go back to the member dashboard very quickly. Clearly a defensive move here with real estate utilities. This makes a little more sense. Yesterday was a little squiggly in terms of which sectors were leading versus lagging, but this is very much a traditional move to defense. On the downside, we have financials, industrials, consumer discretionary, technology, energy at the very bottom of that list. I did want to point out, we're a little short on time, but I did want to point out a couple of very quick themes here. The global equity ETFs, obviously a lot of discussion of China, so I would check out the China ETFs. They're down here toward the bottom of the list, but not necessarily the worst of the bucket, because a lot of other things have been fluctuating as well, but FXI is the one we've usually referred to. Looking at the Dow Industries, though, this is at the bottom of the list. These are the industries that did the worst today, and I'd point out a number of materials, a number of industrials, some random consumer discretionary in there as well, but look at all of the transports in here: trucking, airlines, marine transportations. Those are all part of that Dow Transports. When we talk about Dow Theory, it's the relationship from the Dow Industrials to the Dow Transports, and all of this weakness today is making the transport side of that breaking down. So we talk about whether or not Dow Theory remains okay, or whether we start to break down. Transports actually follow through to the downside with all of the weighting on these industries sort of at the bottom of the return list. So pay attention to that Dow Theory chart that we looked at in our 3 and 3 yesterday. If you missed it, just check out the video on YouTube. You'll see what I'm talking about. I want to move on to our next segment called Sector Setups. We talked a little bit here about some of the sector movements, but I think it's really important to have a regular time when you review some of the sector rotations. And if you're not familiar with this sort of look, I was just talking with Julius de Kempener earlier today. It's morning here, and it was pretty late in the evening for him in Amsterdam, but he generously agreed to jump on the phone so we could compare some notes. And we talked about a number of different topics, but if you've not followed his work, check out his show, Sector Spotlight. It's really, really well done and deals a lot with these rotations. I tend to look at the weekly RRG, the weekly rotation graph for the 11 S&P sectors. It's the main thing that I look at for a sector rotation basis, because what it shows you is the benchmark in the middle, the S&P, and then it shows you how all the 11 sectors are rotating around that benchmark. And what's cool about this, you put it in motion and you can see some of the things evolve over time. So what am I seeing here? We've looked at this maybe in the last week or two, but just to catch you up, these are the 3 really defensive parts of the equity universe: utilities, real estate, and staples. As I go, this is the current bar, and as I rewind a little bit and then fast forward, you can see how they've all rotated from a position of strength in the leading quadrant, all rotating down to the southwest, which is really the first real warning sign. They've now followed through into the weakening quadrant. Now staples and real estate In the lagging quadrant, utilities not far behind, barring some huge change. I think it's fairly reasonable that it will be in the lagging quadrant next week. So overall, you've had this rotation away from the defensive sectors, rotation into technology, into financials, into industrials. What's interesting here, though, is just in the last couple days, we've now started to see a little bit of a rotation. Financials now rotating sort of southeast. Industrials actually now southwest. Energy, which has certainly been the pariah, far to the left underperformer, rotating back down. That's really, from a technical perspective, very little reason to want to own energy relative to any of these other sectors, to be completely honest with you, based on the relative rotation work in particular. That's what the weekly look tells you. So overall, a move away from defensive into offensive, but just the beginning warning signs from some of those offensive groups. If we switch it to the daily view, and if you don't do this, again, Julius does a great job sort of breaking these down. Healthcare is one that had emerged in a position of strength on the weekly chart. On the weekly RRG, you can see on the daily RRG, it's actually the strongest of the 11 sectors. So from a tactical perspective, certainly has been a position of relative strength, and it has emerged out of this improving quadrant on the weekly chart and is really leading up to the northeast, which is what you want to see. Technology, which has been one of the stronger sectors, you can see on the daily work, starting to rotate lower. So all that means is the long term still fine, the short term, the tactical, a little weaker. And I would say one of the places maybe to see how that looks at a stock level is simply to look at the chart of Microsoft, right? So on a relative basis, the chart is still fine. It's holding up very, very well. We could look at the XLK potentially as a different version of that. On a relative basis, still holding up very, very nicely. So this is technology relative to the S&P 500. Overall, leading up and to the right, that's pretty healthy. But we've had a bit of a sell-off and a severe sell-off, breaking below the most recent swing low. So, even more exaggerated than what we saw at the S&P 500, really closing below the low from a week and a half ago. So in a very, very short term, you can see how this is turning lower, but long term, the relative trend is still positive. And that's how I think of these relative rotation graphs. The daily chart shows you just that last little bit. Overall, are we starting to see some relative weakness in technology on a tactical time frame, a couple days to a couple weeks? The weekly picture is you get more of an asset allocation view, more of a weeks to months to years sort of picture, seeing the rotation as sectors come in and out of favor. And this is where you see technology still in a position of strength. So the question is, does that short-term sell-off in technology lead to another leg higher? Does that rotate back up and continue to push this relative rotation further up and to the right as a leading sector? Or is that tactical weakness a warning sign of further price weakness, and we see relative rotation to the downside on the weekly basis? And again, the way I would try to make that decision is by looking at the charts themselves. So what you see with technology overall still not far. I mean, it's amazing how bad 2 days feels after you've come off of this huge uptrend. So remember, we are not far off of significant all-time highs for the XLK and most, if not, many technology names. So let's keep that to front of mind. It's not that bad, regardless of how bad a couple days has been. But a couple warning signs. We're just starting to see a rollover in relative strength. If we would break to new relative lows, and for me, I'm looking at breaking below maybe this low from last month. This is the low from October. This is really that period of sideways performance where the market overall was okay. Technology sort of sideways, and that sort of was a market performer before it broke out and led on this most recent move higher going into the month of December. One other warning area I would say is this bearish divergence. So a higher high in price, a lower high in the RSI. So that's showing you that as the price made that one last push higher, less momentum behind that move because the RSI is relatively weak. And again, I don't see that on its own in a vacuum as the worst thing ever, because there are plenty of times where you get false positives on something like divergences. I don't see any necessarily on this example on this chart, but you will see it plenty of times where there's a divergence, the market pulls back a little bit, but then just continues to accumulate. It continues on a new leg higher. but it puts you on the warning sign. It puts you on the red flag list. So whether we get some follow through tomorrow through the rest of this week, looking at the weekly chart, whether if we get some sort of distribution on the weekly, a new weekly low relative to where we've been, might tell you that there's potential further downside. At this point, it's certainly an area of concern, something to watch. You compare what we saw here from technology versus the seasonal trends that we're at, right? The seasonal tendencies right now is more step on the gas, strength leading into year end, more high beta, people taking profits on things that have been losing and rotating to things that have been winning, because as an institutional money manager, you don't want the baggage on your quarterly report. You don't want to show your clients that you completely missed the boat on some things, so you do some window dressing, meaning you sell your underperformers, you buy some of the better performers so that your portfolio looks a little more stable, which would mean assets should be rotating into things like the XLK, especially things like Microsoft. That's kind of where you'd expect things to go because they've been strong price and relative performers. If we don't see that, that's a very different read than the normal seasonal tendencies. And again, given either the choice of following one or the other, I would definitely follow the price. Look for what you're seeing there. Let's look at a candle glance view of the sectors. So after I like to look at the relative strength in the form of the RRG charts, I like to look at the individual sectors on a candle glance view because it gives you sort of the 30,000 foot view. We now have the rotation. We see where things are rotating. Let's look at any particular price patterns that might give us a sense of where things are headed. So a couple themes very quickly to wrap up this segment. Number one, look at how financials gapped down here. I'm going to zoom into the chart just briefly. This is the sell-off today. So the XLK gap down, the XLF as well, down to the previous high, down to the high from the beginning of 2018. So that's a big jump down. We're now testing the support level. If it would come back lower, that would be the follow-through suggesting more weakness in financials. It's just a pullback as of today, but it's something I'd be looking for. The XLI we can see pulling right back to the 50-day, the same with materials. So we have a couple sectors that have been in a pretty strong position, now pulling back to the 50-day, sort of a traditional pause that refreshes before you continue higher. Second theme I would identify is the weakness in utilities and real estate. Look at the lower highs we've seen from real estate, from utilities, relative to the higher highs we've seen from communication services, from staples, from financials, from all these other places. So utes and real estate, clearly a move away from defensive. The last one, though, is the resilience of healthcare. And this is a sector we've talked about randomly off and on. Again, if you're not there, if you've not been looking at some of the groups there, a lot of people have ignored it because it had been such an underperformer. Look at the relative strength again to new 3-month highs today, based on holding up well as other things sort of suffer. So make sure the XLV or healthcare is on your screening list, on your ideal list for some potential ideas. That's our sector setups for today. A lot of really cool themes. I wish we could dig into any one of those for an hour, but we have to move on, folks. So we're going to take a brief commercial break. We'll be back opening up the Final Bar Mailbag, answering some of your questions. So I'll see you back here in 30 seconds. Hey everyone, welcome back to the show, The Final Bar. Thanks so much as always for joining us on our daily closing bell show. If you've not checked out the holiday promo, this is the perfect time in the month of December to renew your commitment to using good visualizations as part of your process. Hopefully the stuff you're learning on StockCharts TV is helping you use the platform better, but check out StockCharts.com/special if you've not seen the offers that you're going to get going into the end of the year. I wanted to open up the Final Bar Mailbag. This is one of my favorite segments because it allows me to address specifically questions that you sent in. And I will tell you, every one of these are literally questions I've received in the last 2 or 3 days, sort of over the long weekend. Questions about technical analysis, about investment processes, about specific sectors and groups and assets. Anything is fair game, and I'd love to help you understand the markets, understand investing as best as I can. And if it's something I can't answer, if that would be the case, which there are certainly topics that fit that bill, maybe that's a guest I can bring on that can help us address some of those things together. So starting right off, one of the questions I received just yesterday was about when I talk a lot, and my wife, Carrie, reminds me I say higher highs and lower lows about 8 million times a show, and I get it. I'm sorry for that, but I'm not sorry because I think it's such an important concept to keep internalizing, and hopefully you hear me in your head saying higher highs and higher lows, and just as a way to make sure that you're visualizing that on the charts. But the question was in particular, is it intraday highs and lows, or is it closing highs and lows? And the quick answer is, it depends, right? It depends on what chart we're looking at. When I'm looking at a chart of the S&P 500, which is what I'm showing you now, I'm keyed in very much to the intraday low from the middle of November because, again, on an absolute price basis, that is the lowest that we got after we, sort of had a couple days sell-off. That was the lowest point over that week and a half period. And so for me, it represents the weakest point. That represents the absolute bottom that we got to. And whether or not we're able to hold that, I think is really key. But with certain things, you want to focus more on actual closing levels. So when you're thinking about something like Dow Theory, and sorry for just jumping around here very quickly. Here we go to Dow Theory. If I'm talking about Dow Theory, Charles Dow designed this looking at closing prices, and so to stay true to that, I think there's a lot to be said for looking at the closing prices because intraday movements are actually very noisy, right? Day to day, we have a lot of volatility, a lot of range that's experienced, but the closing level gives you a good sense of progression. So if you just look at the closing levels, you will get a sense of where the day ends, where the week ends, where the month ended, and that has value. One of my mentors, Jeff Weiss, who we'll hopefully have on the show here very soon, a longtime technical analyst, he often waits for weekly and monthly closes because until you lock in that closing price for Friday at 4 p.m. Eastern, nothing has happened according to his long-term analysis, right? The rest is just noise until you establish the weekly close. That tells you something has happened. So you will find on the show, I'll try to be as clear as possible what we're looking at. When in doubt, I'm using the intraday highs and lows because those are the levels that I've learned to pay attention to. If I'm just looking at the closing levels like I am here, I will usually show the chart that way, and I'll make a point of telling you we're looking at it on a closing basis. So thanks so much for that question. That's a very, very good one. Second one is a little more soft and fluffy. This is talking about what PCs, what systems we're using, in particular with the ACP platform and what browser you want to use. So if you've not checked out the ACP platform, if you go to your main page, your main dashboard page, you will find a link to go to the StockCharts ACP that'll get you to a really cool demo version that we're running just so you can get a sense of what's happening. It's a great way to jump into all the charts that you find of value and get you comfortable with the interface. We are making weekly updates, rapid updates to this in anticipation of a full release at the beginning of 2020, so keep your eyes peeled for that. But some people have started to get warnings if they're running it on certain browsers. So in terms of what we use, I would say primarily it's Google Chrome. You can see by the 8 million Chrome tabs that I have here at the top, that's sort of what I rely on. So I can guarantee you anything that I test, it's using Google Chrome. So I would suggest going there if you're using something else. Firefox, I'm told some people use with no issues, but Google Chrome is what I tended to use. In terms of the hardware, we're all using Macs for the most part, and I found the charts themselves are really agnostic. So whether you bring this up on a Windows PC or a Mac, it doesn't matter. It's more specific to the browser and the hardware capabilities. Make sure you can run it. But StockCharts is one of the benefits. It's totally web-based. You can run it on any platform. We tend to use Macs less because of the StockCharts experience, but more what happens all the other times we're doing things outside of StockCharts. We're finding Macs to be a little easier, but it can be either. And I've talked with clients that use both Windows-based and Mac-based, and it's no problem. But again, browsers in particular, Chrome is the one that I tend to use. So thanks for that question. More of a market-oriented question number 3 here was on balance volume, and someone had asked in particular about how you use on balance volume for broader market indexes, and we looked in particular at this example. Here's the S&P 500, so I'm looking at a daily bar chart, looking at some long-term moving averages, and then looking at just a daily volume read on the S&P 500 stocks. And then this is the OBV, the on-balance volume. And if you're not familiar with that, check out the Chart School article on OBV. It'll give you all the details, the simple calculations behind it. But very simply, it's taking the daily volume read and taking a cumulative measure, accumulating all those daily volume reads over time to give you a sense of volume over time. So if the stock or the asset trades up on the day, closes higher, that day's volume is considered positive. It's added to the total. If it's a down day, then that day's volume is subtracted from the running total, and that gives you an overall on-balance volume. So the daily volume read is good for getting some individual relationships. Is the stock up or down on heavier or lighter volume? The on-balance volume gives you a better sense of that trend over time. And over time, is there better volume on up days or down days is essentially what you're doing here. Here's the on-balance volume for the S&P 500. I am now switching to the spiders, and I'm going to quickly scroll back and forth between these two charts. Do you see any differences on the on-balance volume at the very bottom of the screen? And hopefully you do, right? This is the SPY, the spiders. You can see that the on-balance volume has not come anywhere near really to the high that we saw in May. We retested that in July, and now we're back up to those levels, but haven't gone higher. But if I look at the S&P 500, you can see that the indication is actually very different. We're seeing the on-balance volume at a higher point than we have at other points here. So which one should you use and why? Now, the short answer is it's hard. It's actually very challenging, and I'll tell you why. The S&P 500 is actually looking at volume on the individual S&P 500 names, and it's rolling up to a total volume for the S&P stocks. That's why you see numbers in the billions over here on the far left side. On the S&P 500, you can see the volume's a lot lower because that's looking, and again, it depends on what your account is, what sort of volume you're looking at. I'm looking at a certain exchange and looking at the volume read there. But depending on what pricing source, what data source, if you're looking at real time, all these different things will affect what the volume looks like during different parts of the day and over time. So what I would encourage you to do as much as possible is look at the on-balance volume on the most important, the most tradable, the thing you're actually looking at. So for me, if I had to pick one of the two, I would look at the spiders because that is a purely traded security. The volume is a good read on the volume on the spiders, and it gives you a good sense of it. But for other things that are not tradable, if you can get an index like the S&P, and that's the best you can do, then that's certainly a suitable alternative. But for me, I tend to look at the spiders. I tend to look at the ETFs as much as possible. That's one of the benefits of getting a good volume read from ETFs because you have an accurate volume picture on a specific security as opposed to sort of an artificial aggregated volume from a lot of different sources. Those are the questions today from the Final Bar Mailbag. Thanks again. Please keep them coming to us anytime. I'll remind you at the end how to do that. But we need to move on to wrap up today's show with the 3 and 3. These are 3 charts you should be following, and if not, up until this moment, I hope from this moment on they're on your watch list. The first is gold. I did a podcast interview this morning, and we talked all about gold and sort of an outlook for it. This was the chart we looked at, and this is before today's trading. We've had a nice rally in gold, and as you know, sort of a risk-off move, people moving away from equities and into bonds and gold today. But what we talked about in particular was the relationship of the current price, looking at the last couple months, this pullback after a nice uptrend, a pullback to a Fibonacci support level, the RSI getting right down to about 40, all looking potentially as an opportunity to buy on weakness, and we related that back to the beginning of this year, the second quarter, where we had a nice rally in gold. We had a pullback, lower highs, which is what we've seen here. Pullback to a Fibonacci support level, which is what we've seen here. RSI remaining stable around 40. And again, in a bull market phase, that's where the RSI tends to get down to, but it doesn't tend to get any lower. So those couple inputs made it feel like today's look at gold felt very similar to what we saw back at the beginning of the year. Today, we certainly had a nice rally pushing gold above the most recent swing high. So at this point, pretty interesting. It'll remain to be seen whether or not we see the follow through to the upside and accumulation in gold. But overall, bullish long-term picture for sure. So keep an eye on that. Going very quickly, the second chart is the XLK. We talked earlier about a potential rotation away from technology on a tactical time frame. I'm looking very carefully at what we do relative to the most recent swing low. Is today just an anomaly? We accumulate into the close and this is the next leg higher, or is this the beginning of further downside? I think the relative strength will tell you a lot about which way you may want to lean on something like tech. And then the third chart for the 3 and 3 is the chart of Microsoft. And again, if I had one chart and it wasn't the S&P 500, the chart of Microsoft, consistently one of the biggest companies in the world, biggest stocks, huge weight in anyone's benchmark. I think it's really important to see this still in a position of strength, because if it's not, that tells you that people are rotating away from risk assets away to other places. For me, a breakdown of short-term support is what I'd be looking for in the short term. Longer term, you'd need a break below the 50-day and maybe a break below 140, which would take us below the highs from July, September, October. But that is the chart, especially the relative strength, whether this RSI overbought condition continues to the downside. Really important chart to pay attention to here. That is our show for today on the Final Bar. I want to thank you so much for joining us today and every day here on StockCharts TV. Help us round out the day's activity from a technical perspective. Please keep your questions and your feedback coming. Those questions from the mailbag today were from viewers like you, so I'd appreciate your questions and feedback. The Final Bar at StockCharts.com is the best way to get a hold of us. You can also enter comments or questions in the chat during the show or get to us on Twitter at Final Bar SCTV. For StockCharts.com in Redmond, Washington, I'm your host, Dave Keller. Have a great night.